Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome back to the second episode of Insurance Matchmaking. Again, I'm your host, Matt Libby, and brought in Dana McKinney in again this week. We were talking about a lot of things last week and just kind of didn't really felt like we finished what we wanted to cover, so we figured we'd go at it again. We talked a little bit more about last week was kind of like how I got started and some aspects about Medicare. And as I mentioned, if you didn't listen last week, that's kind of my passion is working with that senior market. And I am one. I'll actually be 65 this December, so I will become my own agent for that. But Dana had some questions about life insurance that we didn't really get into, and so where would you like us to start on that, Dana?
Good morning, Matt. Thank you so much for having me back. I appreciate being back here. So we started to talk about life insurance and all the different facets of life insurance, and you hear so much out there in the market of term insurance and disability life, short-term life, these different catchphrases in regards to life insurance. So if you could just kind of muddle through some of that and unravel what's the importance for life insurance and what are the different types that they have that you sell?
Excuse me. There's really kind of it can be kind of categorized in two things. We do have what we call term, and then we call permanent. Those are your two main aspects of life insurance. And the term that's exactly what it is. It's good for a certain term, whether it's 5 years, 10 years, 30 years. You buy that insurance, and it covers you for that period, and then it expires. Okay. So that's usually your lower cost insurance because it does end. And a lot of times you can renew those policies, but you're going to, if you have a 30-year policy, the insurance company's figured, okay, this is what it would cost for that 30 years for this insurance based on what your life expectancy is, based on your health rating, because they do what's called underwriting.
I see.
And a lot of people are like, well, underwriting, what's that? And there's people, that's their job. They look at, they'll look at your health history and think, of course, height and weight's always a big deal when it comes to,
sure,
age, height and weight. Those are kind of the two main factors in any life insurance policy.
Sure.
And then you've got those people who look at the actuarial tables, and they're the math whizzes that I'm not. But they'll look at, okay, what's the life expectancy of this 35-year-old non-smoker, 5'6", 150 pounds. It's probably, and then they rate those plans.
Okay.
And so, you can get a standard rate, you can get a preferred, you can have super preferred, substandard, table rated. There's all kinds of different ratings of where you'll fall on that spectrum of, and so basically it's kind of like the insurance company's kind of gambling on what's the likelihood of we're going to have to pay out this death benefit in that term.
I follow. Yep.
So, so the same person, if they get a 20-year term versus a 30-year term, they're going to pay less per month because there's 10 years of coverage that they're not projected paying for.
Right.
So what happens at the end of that term, most of them you can renew it, but then it's usually so expensive at that point, they're kind of like, oh, I don't want to pay that much for it, and so they let it go. And so a lot of times they don't have insurance.
I follow you.
So then the other side of the coin is we have what we call permanent life, and that's either usually a universal life or a whole life. And the reason they call it whole life is you're going to pay a certain amount for the rest of your life for that life insurance. And generally the way they figure those is this is what it would cost if you paid for the insurance until you hit age 120, which I don't know many people living to 120.
Right.
But that's kind of where they figure that.
Right.
And those policies generally are a little more expensive because they are figuring that that you're going to keep paying for it. You're not going to be just 10 years, or you're not going to be just 20, 30 years paying for that. They're going to so it's more expensive on the insurance, but those policies also build a cash value.
Huh.
So that's usually how they're presented. That, well, yes, this is going to cost you an extra $100 a month, but 10 years from now, you might have $100,000 of cash value, or you're $50,000. It just depends on the structure of the plan and how much the cost is going to insurance and how much is going to keeping the policy going.
I follow you.
And so then a lot of times they have what they do. You can do like policy loans, so that something comes up, you have an emergency, and you can go to your loan. Based on what your cash value is in that policy, take a loan out on it. If you pass away and haven't paid back the loan, it'll just reduce the death benefit by how much you owed on the loan. So that can be a good vehicle to protect your future, and also just know that you're always going to have permanent life insurance. The other thing I run into a lot is people are like, I don't need life insurance. I got life insurance at work.
So what's that mean? I mean,
well, usually, most employers will provide some type of life insurance, and usually there's a portion. If they do benefits,
right,
they'll provide that, that term life that may be, a flat amount, or it's 1 or 2 years' salary, however, depending on the company. The problem is you don't own that life insurance; the company does, and anything changes in your job status with them, that insurance is gone. You change jobs, you get fired, the company goes out of business.
Risky.
That insurance is gone. And the problem is, and like I love to tell young people, when I'm talking to them, it's like, get insurance now. It's really, it's so cheap because you're young and you're healthy. Right. And my catchphrase on that is, don't wait until you're old and round like me to get life insurance.
Waiting too late can have it. Yeah, can have it set back.
And so that out, but that's another avenue, as you said, waiting too late. Yeah. We have what we call final expense insurance, and again, that's a whole life policy, and a lot of companies don't even offer it to anybody under the age of 45. Is because again, final expense insurance, it's whole life. You keep that policy, the insurance company is going to have to pay out that benefit to the beneficiaries. So they're usually for people who, a lot of them are usually in their 60s. A lot of times my Medicare clients, that's when they realize it's like, I don't want my kids to have to pay for my funeral. I don't want my kids to have to go and do that crowdfunding. I almost said what I usually say on that one. I better skip that.
Yeah.
But funerals are expensive.
Yes.
And it's one of those. It's a great industry to be in because you're always going to be in business because there's always a need for it.
Absolutely.
But what happens is usually if you wait till you're older, generally heavier, maybe not the best of health. Now you're taking blood pressure medicine, maybe diabetic, and so a lot of your traditional policies you either can't get them or to get a term at 60 years old, you can get a 10-year term, but again, at 70, it's gone.
Right. So at this point, like at the 50s, they've already developed, like around this age, some pre-existing conditions, we'll say.
Right.
Right. I see. Okay.
And so those policies can be a little, they're not real expensive. You just don't get a lot of coverage. You can get just $5,000 if you need it, or you can get 10 or 15. They're usually, most of the plans I've seen that work like that. Usually 30 to 40,000 is the most someone can get. There's some that'll go to 50,000, but then again, of course, that's whatever increase in the death benefit, it goes up. But they're like, well, I just want to make sure my spouse or my kids isn't stuck with a big bill to do the funeral, and they can put aside a little bit a month. And then some of those plans, like I said, you're paying for them for life, but some of them do have you can have a 10 pay, what they call 10 pay or 7 pay, and you're paid up. So you pay a higher amount for 7 years or 10 years, however that's structured. And then after that time, you don't pay any more. So like somebody, if they're looking at 55, planning to retire at 65, that 10 pay can be a great deal for them because they know, hey, I've got the money, I'm working now, I'll pay that higher premium because when I retire at 65, I'm paid up and I don't have that bill anymore. But it's still a whole life insurance policy, so it's not going to go away.
I follow. Okay.
So the other thing is a lot of people don't like life insurance because they say, well, it's not life insurance, it's death insurance.
Yeah, there's that mindset out there. Yeah, I've heard that.
And it's like, I don't care when I'm gone, bury me in the backyard.
Right,
Something, they're like, yeah, I don't need it.
Right.
But the neat thing is, we, a lot of times we'll ask somebody, it's like, if they have life insurance, do you have the new kind or the old kind? And they're like, what? And there are plans out there now, they're called living benefits or accelerated death benefit, depending on how they do. And again, those policies, something drastic happens. We were talking before the show here, talking about cancer. Somebody's got a $100,000 life insurance policy, and all of a sudden they find out they have cancer, and they need money to pay for experimental treatments,
Sure.
or they've been given so long to live, and now they want to take that bucket list trip with the family while they're still healthy enough to do it. They can basically advance that death benefit. And usually the way those will work is like 75% or 90% of the death benefit can be accelerated and drawn out, where you still have that 10 or 15% left to still have that final expense coverage. So you don't cash out your life insurance, but you have something that can cover some of those things that come up because you get a terminal or chronic diagnosis.
I follow you. Yeah, and you've seen those cases.
Sure.
Yeah.
And it's tough. Healthcare just costs so much, and that's why life insurance is kind of a big part of healthcare too. Mm-hmm. That we have policies that just kind of insure against some of those things that accident insurance. We talked last week about disability insurance.
Right. Yeah.
Those things that you want to protect your paycheck, or the study. I should have had the numbers written down so I was ready on this, but it was it was like 75% of bankruptcies were due to medical bills.
Mm-hmm. Yes. Yeah.
And 90% or I think it was 66% of bankruptcies were due to medical bills. 75% of those people had health insurance.
Oh wow.
But
that's very high percentage.
Yeah, but
wow.
The thing is, you get hurt or sick and can't go to work. You may have some leave time paid up, but then you're not working, you're not getting paid.
Right.
So your health insurance paid the doctor, they paid the.
Yeah.
But you have other bills.
Right. Yeah.
We don't talk about car insurance.
Oh,
Put gas in the car, groceries, light bills, rent, mortgage, all those things that kind of add up. That so some of those policies can come in and kind of cover that. So it looks like we're heading into that commercial break, and we will be back with you in a few moments.
And now, back to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance, hosted by Matt Libby.
All right, Dana, we're back, and I know we had some questions. We were talking about term insurance. What questions did I leave you with there?
So the term insurance, tell me more about how it works. Is I pay in a certain amount and at a certain age, and do I have an accumulation of this? And what happens if I don't die? But I get a diagnosis, right?
Right.
What happens to all that money? Tell me how the term works.
Okay, so that's so you generally you can renew those policies.
Okay.
So, but like you're 20 years older, so you're now buying it at, you bought it when you were 35.
Like 35, 40.
Sure. Now you're 55, so you're going to pay that 55-year-old rate. You can renew it, and you won't have to go through the health questions then because you're renewing the policy that exists. So you can continue it, but it's going to be a much higher rate. That's one of the downsides of term. Is your rate's going to be higher when you decide to renew it. The other thing is, or you decide not to renew it, it's kind of like you're getting that notice from the insurance company. Congratulations, thank you for paying your premium for 20 years. Congratulations, you didn't die. Thanks for the money.
Yeah.
And that's why a lot of people are like, why am I going to do that? I'm just paying them. They're betting that I'm not going to die before that.
Right.
The other thing is, and it's a little more expensive, but it's going to be less per month than that whole life plan we talked about. But there are plans out there that have what we call ROP, or return of premium. So what that'll do is you're paying a little bit more to have that option, But at the end of 20 years, they refund your premium.
Oh, nice.
So you can have some lump sum cash at the end of that 20-year term. So it's kind of that's kind of a win-win in that.
It's a win-win.
Hey, it's not congratulations you didn't die. Thanks for paying us for 20 years.
Yeah.
But they're going to say congratulations you didn't die. Here's your money back.
Yeah.
Because what it is, what insurance companies do is they invest your money.
Yeah.
When you're paying that premium so that they have the money in their reserves to pay out those death benefits, they're taking that money somewhere and investing it, whether it's stock market, real estate, wherever they decide to invest that money. So if you're paying a little bit more for that return of premium option, they got a little bit more money. They don't have a problem paying you back because they used your money for 20 years.
Right. Now, do they pay you back with the interest, or is it
No, well, no, it's not with interest. So it's basically going to be that amount of that premium.
You paid in.
So, like I said, it costs a little bit more, but that's kind of your three stages you're looking at. It's like, okay, do I want the most amount of insurance I can get for the least amount of money? You just buy a basic term plan.
Okay.
And it actually is kind of another kind of in between that and return of premium. We talked about the living benefits. Some of the plans, those are riders that you pay a little extra for.
Okay.
Some of them it's built into the plan. Some of them it is. Well, this plan, and that's why. And again, you'll have different rates. This plan's going to be a little bit more expensive because it has those accelerated benefits. And the return of premium plan, they're going to charge you a little bit more. You're what we call riders. You're paying that little bit extra to have that option added. It's kind of like when you buy a car, you got the basic car, but I don't think they make them anymore. But it's like, it used to be the difference. Do you get the electric or the crank windows?
Right.
Do you get the air conditioning or not?
Yeah.
I grew up in the Northwest. Air conditioning was an option when you bought a new car.
Right.
They don't do that in Tennessee. It's basically they don't come without air conditioning these days.
Exactly.
But those are kind of options. And then again, we talked about the whole life plan where you're building a cash value. You're outlaying more money, but the other thing, you don't lose your money. And I talked about like the final expense plans that you're paying that money in. The death benefit will be paid, and the death benefit's going to be more than you paid in, so you don't lose there. The other thing is sometimes there are people who, like we said, they waited way too long to buy insurance, and now they have health issues.
Yeah.
And most companies are going to turn them down. We do have some plans out there, and some companies offer what's called guaranteed issue.
Okay.
The downside with those guaranteed issues is if you die for health reasons in the first 2 years or 3 years, depending on they're not going to pay out the death benefit because they normally wouldn't insure you. The good news is, again, you didn't lose your money.
Okay.
They will refund your premium plus a percentage.
All right.
So it's not just throwing the money away.
Sure.
Whereas, like with the term plan, you kind of are throwing your money away because if you stop paying it,
you don't,
and you just like you stop paying it because that insurance cancels.
Sure.
Versus with the whole life plan, it's going to pay something, but that's one of the risks of the final expense insurance is, are you good enough health to get what we call day one coverage? So there's 3 levels generally. You'll have that day one coverage that it doesn't matter whether you have a car wreck or you have a heart attack, it's going to pay.
Right.
And then they have ones that have graded benefits. So maybe if you pass away in the first year, it's only going to pay 30%.
Yeah.
But it's still more than what you paid in, and it's more than your premium. So it's a good plan like that. And those plans, if it's an accidental death, like I mentioned, the car wreck, if you're in a car wreck and you pass away, those plans will pay because your health had nothing to do
with the fact
that you passed away. But they're saying, we're taking on the risk of giving you a life insurance policy when you've got one,
right?
The proverbial 1 foot in the grave.
Correct.
But at least they will cover that.
I got you. So let me ask you something, Matt. Where would you say is the right age for someone to start coming to you even to talk about because I have nothing as far as life insurance. You know, we talked about this.
Talk.
We need to definitely talk. I mean, I have nothing. So if anybody's thinking of taking me out, you're hitting the wrong target. I have nothing. I'm not covered. But you know, you've got me thinking. You've honestly got me thinking about some things, and there were some things I was just uneducated and had fear and had mythical information about.
The other thing is, a lot of times people just think it's so expensive.
Yeah.
I've got one company now that is offering a plan, and it's geared towards basically to millennials. You know, and millennials, you know, they're in their 30s, getting close to 40 now. We think of millennials, we're thinking, oh, those are the kids just getting out of college or just getting. No, that's Gen Z. We're past that. But the millennials, again, they think they're still in that mindset that I'm 10 foot tall and bulletproof. And also, a lot of them don't have kids.
Right.
You know, they're waiting later to get married, later to have kids, instead of thinking, I don't need life insurance because I don't have a family. So this plan is geared to it has an accidental death benefit. It has a critical illness, like, you know, if you have a heart attack or you get cancer, it'll pay out of cash for that. And then it also is a term life plan, and it has it's term, and it has disability coverage. So that would be a great that's a great plan for them. So it's kind of a triple package to cover some of those concerns that they may have. And again, it's very inexpensive. You know, if you're in your 20s, 30s, 40s, 50 is kind of the mark where you just expect everything to be more. Yeah. And every year it's going to go up. Your rates go up, but when you hit 50, it's more. It's like it's a lot more for somebody 50 than somebody 49 versus the difference between 48 and 49.
Right, because now you're probably bringing on some pre-existing conditions because your health because we're growing. So insurance can be expensive, right?
Can be,
but how much is the cost of dying? I mean, in comparison.
So, typically it can range depending on if you want all the bells and whistles, but $12,000 to $15,000 is kind of an average cost for funerals right now.
Wow. Yeah, that's expensive.
And that's why those final expense plans that come in here. Like some people say, well, I'm just going to be cremated, and there's still a cost though.
Yes.
It may not, but if you're going to do a traditional funeral with a casket and a burial, it's usually at least $10,000, $12,000.
Wow. Versus the cost of insurance.
Right.
Yeah. Wonderful. I mean, that's high numbers. I don't have that in a savings account right now. And going back to your example, the millennials and Gen Zs, I don't think they do either.
Right.
So they're just not really prepared and need to be. So, I mean, as far as tell us more about the universal. I don't know if you touched on the universal.
Yeah, I didn't. The universal is very similar to whole life. And what they do generally, it's like we call them index universal, IUL. And what they do, as I mentioned, the insurance companies invest your money when you pay. And so the universal life will use an index like, the not Fortune 500, the Standard & Poor's, the Dow Jones average or something. They'll use something like that as their index based on how that policy or how that fund earns. That will be like the percentage of your cash building. And what they do with that index is, but it doesn't lose. Like a lot of times, people will invest money in the mutual funds.
Mutual funds, yeah.
Those are very volatile. You have a higher risk.
Sure.
If the stock market crashes, so does your mutual fund account.
Sure.
Whereas that universal life plan, you don't lose anything. It's just not gaining anymore because the fund's not making any money. And then when the fund starts making money, it'll go up again. And your money's not invested in those things. That's just the guideline they use to rate the earnings. So what happens is with the universal life, I mentioned the whole life earns. Generally, a universal life is probably not going to earn as much as the whole life.
Okay.
But there are some risks with the whole life that you could lose money versus that they're not going to lose it because based on the index, you're just not gaining.
I follow you. Okay.
So, all right, Dana. One of the things I wanted to do, I thought about it afterwards. You talked a little bit about what you do with your with Cygnus, and one of the things I thought unique was there are businesses out there that are non-traditional that aren't able to get affordable credit card processing because of what they sell. Would you like to touch a little bit on that?
Yeah, thanks. Actually, we're seeing right now in higher numbers than ever, we're seeing small businesses shut their doors right now. And one of the things that they pay so much for is their credit card processing fees through POS systems that just jack up the fees as high as they can possibly. It is my passion to try to help stop the bleeding on some of these businesses that are looking at closing right now, because we actually provide software as a solution like a Square for about 10 different business industries, salons and other stores and restaurants that can actually eliminate 95% of their processing fees right now, which could literally save them thousands of dollars a year. Oh. And so I'm looking to help any business that needs to trim the fat or trim their budget or save some money to keep their businesses open so that we can continue to support them. Those are businesses I really would like to help right now. Just to have an introduction, just to come out and say and see what we have. We are a full financial technology solution software for small businesses. We most likely have some sort of a software that can actually help you all out right now. So I would definitely love the opportunity to get in front of some business owners and see what I can do to help.
All right. So as we mentioned, we didn't really plug the website here. It's real easy to get in contact with me. The name of our program is Insurance Matchmaking. And if you go to insurancematchmaking.com, that'll take you to the website, and you can get my contact info. If you got questions for Dana and say, hey, I listened to your show, can you put me in contact with Dana? I can do that. And also love to have feedback, questions of, hey, you talked about this, but can you explain this a little bit further? Other thing. As I say, I do health and life insurance. My niche is probably Medicare, and or if maybe you have a guest idea that you think, hey, I know this is related to insurance. Can you get this person and have them answer some insurance questions and be on your show? So please send us suggestions and let me know what you'd like us to cover in further episodes. And tune in again next week, right here, 10 o'clock on Saturday.
Thanks for tuning in to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance.